Good morning, dear students. Welcome to the home mentoring session of accountancy. Myself, C.S.K. Khanna from the SP Vidya School, Ambala Kent. Dear students, in our previous lectures, we had learned one aspect of the lesson ratio analysis relating to the liquidity ratios or the short-term solvency ratios. Under there, we had learned how to calculate the current ratio as well as the quick ratio or acid test or liquid ratio. Let's discuss the second aspect of the solvency ratio, that is known as the solvency ratios or the long-term solvency ratios. Dear students, first understand why we calculate this ratio. This ratio is calculated in order to know the long-term financial strength of an organization, which means that whether an organization is having the financial sound health or financial health to make the payment of all its long-term obligations as and when they become due, which means that whether a business is in position to pay its long-term liabilities. Long-term liabilities here means that is a period of running 3 years to 10 year, 20 year, 30 years onwards. So in order to calculate the financial health, financial strength of an organization on long-term basis, we calculate the long-term solvency ratios or solvency ratios. Under this, in our syllabus, we had the 4 important ratios. First, it is called the debt equity ratios. Debt equity ratio here means a ratio which shows the relationship between the debts. Debts here means long-term liabilities or non-current liabilities, and equity here means the equity shareholders fund. Once again, a ratio which establishes a relationship between the long-term liabilities or long-term payments or non-current liabilities and the equity shareholders fund. That ratio is known as the debt equity ratio. The formula to calculate this ratio is debt or long-term liabilities divided by equity or shareholders fund. When we establish a relationship between these two variables, it is calculated debt equity ratio, and the objective or idea is to know the long-term financial strength of an organization. Here, while calculating this ratio, debt includes long-term borrowings and the long-term provisions. Long-term liabilities, all the liabilities which are payable beyond a period of 2, 3, 5 years or 10 years. So this includes debts, long-term borrowings plus long-term provisions. And here, with reference to the equity shareholders fund or the equity, it includes share capital, reserve and surpluses, and non-trading investments. Equity shareholder funds include share capital, reserve and surplus, and all other free reserve and surpluses and non-trading investments. Or if we want to calculate from the asset side, we can also calculate equity shareholders fund from the asset side, and it includes fixed assets, that is tangible and intangible. Fixed assets include both tangible as well as the intangible assets. Then non-current investment excluding non-trading investments, long-term loans and advances, current assets minus current liabilities minus long-term borrowings minus long-term provisions. So you will notice that the equity shareholder fund can be calculated from both the angles, that is from the liability side as well as from the asset side. While calculating from the liability side, formula is little bit easy as compared to the calculation through the asset side. But here we have to divide long-term liabilities with the equity or shareholder funds, and the result will be the debt equity ratio. And this ratio is ideally treated as the 2:1. That means that if the debts are doubled into the equity, if the equity shareholders fund is doubled into the debt or long-term liability, it is considered as the satisfactory. If it is more than that, it is not satisfactory. So this way we will calculate the very important first ratio, that is the debt equity ratio. The second ratio which we will calculate, that is the total assets to debt ratio. Please understand, in case of the debt equity ratio, we calculate the relationship between the long-term liabilities and the equity shareholder fund. But in this ratio, as the title itself say, total assets to debt ratio, we establish a relationship between the total assets to the long-term liabilities and long-term provisions. As the name say, total assets to the debt ratio. The formula to calculate this ratio is also very easy. That is total assets divided by the debt or long-term liability. Total assets here means that again we can calculate from the asset side very simply. Total asset, that is fixed assets or non-current assets, tangible as well as intangible, plus non-current investment, that is excluding non-trading investment which could not be traded, then long-term loans and advances, plus current assets. And debt here means again long-term borrowings and long-term provisions. Dear students, understand that total assets you can also calculate in a very simple way, that from the total of the asset side of the balance sheet, you could deduct or subtract the fictitious assets. The result will be left out to the total asset, and debt here again the same meaning, that is the long-term liabilities. So if we divide total assets to the total liabilities, that is long-term liabilities here, result will be total assets to the debt ratio. Likewise here, as it is say that no ideal ratio, but a high ratio indicates higher safety to lenders and low ratio represents risky position. Higher the ratio, it means the long-term liabilities are more skewed. For example, total assets are 10 lakh and debt or long-term liabilities are 2 lakh. It means it is 5 times. Higher the ratio, more the safety is there. Say another example, total assets are 5 lakh and the long-term liabilities are 2 lakh. So it amounts to 2.5:1. So it is a risky proposition as compared to the previous example where total asset to debt ratio is 5 times. So this way we will also calculate this ratio, that is total asset to debt ratio. Now we will learn how to calculate the third ratio, proprietary ratio. As the name itself say that it is the ratio which is calculated with reference to the proprietors fund here. Proprietors fund here with reference to the companies, that is the equity or shareholders fund. This ratio is a combination of the first and the second ratio, that is the debt equity ratio and the total asset to debt ratio. See, in case of the debt equity ratio, the formula was very simple, that is debt or long-term liabilities divided by the equity or shareholder funds in reference to the total assets or the debt ratio, that is the second ratio. Formula is total assets divided by debts or the long-term liability, and third ratio is proprietary ratio. It shows the relationship between proprietors fund or shareholders funds and the total asset of the business. Formula is equity or shareholders fund divided by total assets. So you will see that this formula is a combination of two important elements of the previous two ratios. With reference to this, to the debt equity ratio, we had the equity shareholders fund, and divided by total assets, it is a part of the total asset to debt ratio. So here the objective is to calculate a relationship between proprietors fund, shareholder fund, and the total assets of the business. So this way we will calculate the proprietary ratio. The last ratio under the solvency ratio which we calculate, that is known as the interest coverage ratio. Dear students, understand the basic purpose of calculation of this ratio is that how many times the profits are sufficient to cover the interest on the long-term liabilities. Again, the objective of calculation of this ratio is to know that how many times the ratio can cover to the interest liability relating to the profits of the business. So what is the formula to calculate this ratio is? That is also very simple. That is net profit before interest and tax divided by fixed interest charges. Here understand, the formula is net profit before interest and taxes. Interest here means interest on the long-term liabilities, and tax here means income tax. Again, net profit before interest and tax means net profit which is before charging interest on the long-term liabilities, and tax means the income tax, divided by fixed interest charges. Fixed interest charges here means the total interest which is payable on the long-term liabilities. See here, the further points clarify to this ratio. Point say, since interest is a charge on profit, net profit taken to calculate this ratio is before interest and tax, before deducting the amount of long-term interest and the income tax, whatever the profit is, that is taken for this particular formula. Objective and significance of this ratio is to ascertain the amount of profit available to cover the interest charges. Here please again understand, interest charges here means interest on the long-term liabilities. Parties interested in this ratio are debenture holders and lenders of the long-term credit. All those parties who had given long-term loans to the organization, they are very much interested to calculate this ratio because they want to know whether the profits are sufficient or not in order to cover their interest or cover the long-term interest charges. So this way we had learned to calculate the long-term solvency ratios, and under this we had covered the 4 important ratios, starting from the first ratio, that is the debt equity ratio, which established the relationship between the debt and the equity, that is equity shareholders fund. Then total asset to debt ratio, which established a relationship between the total assets of the organization with the long-term liabilities. Proprietary ratio, again a combination of the first 2 ratio that establish a relationship between the 2 important variables, that is equity or shareholders fund or the total assets of the organization. Last ratio which we had calculated, that is with reference to the most important element, interest coverage ratio, that whether the profits are sufficient or profit covers how many times the long-term interest or the interest payable on the long-term liabilities. So this way we had covered the solvency ratio, short-term as well as the long-term solvency ratio. I will continue in my next video relating to the calculation of activity or turnover ratios.